good morning. You're watching Market Cafe on ET Now with me, Snehisha, and along with me I have my co-anchor Ankita Saxena. Very good morning to you, Ankita. And this is a show where we take you through all the top global stories happening around the world and all the important updates coming in terms of the markets, what happened yesterday, as well as what you need to be watching out for today in trade. And also towards the end of the show, we'll go stock specific and tell you about all the important stocks that you should be keeping on your radar. But Ankita, let's start off the show then with the global handover. And when we talk about US, major inflation numbers are due today, and inflation is likely to largely moderate. That's what all the polls are estimating. So tell us what the global handover look like.
That's correct, Snehi. We have the big inflation data coming out today, CPI numbers, and tomorrow we have the producer price index coming out. So all eyes on that. But before that, we did see a little buying coming in the US market. So yesterday the stocks rose a day after the major averages snapped a 3-session decline as traders await the key inflation data, as I mentioned, slated for release today. Tomorrow, the Dow Jones Industrial Average advanced 317 points. The S&P 500 rose more than 0.5%, and the tech-focused Nasdaq Composite gained 0.5% in trade. Now, Salesforce stock rose nearly 4% after the company announced it would increase prices across the board in August. And we also saw Activision Blizzard's shares jump 10% in trade yesterday. And the June's Consumer Price Index report is set for release today, and the June's Producer Price Index is out tomorrow. So all eyes out on that. That will pave the way for the Fed's interest rate hikes, and of course the market is penciling in a quarter-point raise in the coming meet, which is on the 25th and the 26th of July. Moving on to the European markets took a cue from the Wall Street and also ended the day on a higher note. The Pan-European Stock 600 finished the day more than 0.5% higher as almost all the sectors nudged into the positive territory. DAX was up 0.7% and FTSE was up 0.1% in trade. So largely positive handover coming in there.
Absolutely, largely positive handover coming in. All eyes will be on the key inflation data expected tonight as well as tomorrow. But let me also give you a roundup of what crude did then. And oil prices jumped on Tuesday, settling up about 2%, boosted by a falling US dollar. Hopes for higher demand in the developing world as well as supply cuts by the world's biggest oil exporters. Now, Brent settlement was its highest since April 28 and WTI since May 1st. Brent was in technically overbought territory for the second time in 3 days. Now, the US dollar dropped to a 2-month low against a basket of other currencies a day after the several Federal Reserve officials signaled the US central bank was near the end of its tightening cycle, and a weaker dollar makes crude cheaper for holders of other currencies as well. And with that, the Brent crude is at 79.5 mark, and a barrel as well as the WTI crude is almost at the $75 per barrel thereabout, currently at the 74.95 levels.
All right, then Snehi, let's quickly take our viewers through the events that we will be tracking very closely through the day. Today is the last day for trading for HDFC Limited on the bourses. Remember, the HDFC Bank and the HDFC Limited merger happened, and today is the day when HDFC Limited stops trading as HDFC Limited and will start trading as HDFC Bank. We also have the earnings season kickoff from today. We have TCS and HCL Tech that will be reporting their quarter earnings today. We also have the US CPI number, as we mentioned, and the India CPI number that will be coming out today. And in the IPO action, we have Utkarsh Small Finance Banks that will be opening for the subscription today. And in the annual general meeting, the AGM, we have Wipro, Embassy Office Parks, and Deepak Spinners who will be holding their AGMs as of today.
Alright, let's keep an eye on all the important global updates coming in, and then all eyes are on the important US inflation data that could impact the Fed's policy decisions. Now remember, headline inflation has been on a constant downward trend since it peaked at 9.1% in June 2022, but it has fallen for 12 consecutive months to its current pace of 4%, and this trend is expected to sustain. Core CPI is also expected to cool off, even though it has remained stubbornly high, falling to only 5.3% in May from the peak of 6.5% in August last year. The expectations for core CPI range between 4.9% to 5.2%.
And shifting focus now to US equities. Now, due to the surge in some of the tech players this year, Nasdaq has announced that it will do a special rebalance of the Nasdaq 100 index, which will come into effect before market open on July the 24th. Now, do remember, the tech-heavy index has notched gains worth nearly 36% this year, well above the pairs S&P and Dow Jones. The index rebalance is expected to address over-concentration by means of redistributing weights.
Alright, and staying with news flow from the US then, lending giant Bank of America has agreed to pay as much as $250 million in fines and compensation. The said payments are to settle claims around the bank double charging customer fees, withheld promised credit card perks, and opened accounts without customer authorization.
And well, shifting the focus to the geopolitics then, China, where President Xi Jinping has called for opening up of the world's second biggest economy on a larger scale. The move to ensure focus on foreign cooperation in areas including trade and investment. He also added that foreign consultancy breakdown has weakened investment appetite for China.
And from China, let's move west to the UK then, where mortgage rates have shot up to the highest level in 15 years. Mortgage rates have been soaring amid inflation and uncertainty over interest rate hikes by the Bank of England. The average rate on a deal is now 6.66%, a level not seen since August of 2008, which was also the year of the financial crisis.
An OECD, or the Organization for Economic Cooperation and Development, flags risks to jobs with the emergence of artificial intelligence. More than a quarter of the jobs that rely on skills can be easily automated in the upcoming AI revolution, says OECD. They added little evidence of the AI emergence on jobs so far, since the revolution is in the nascent stages.
And let's also get you the latest geopolitical updates then. US President Joe Biden will be meeting Ukrainian President Volodymyr Zelensky at the NATO Summit. The meeting will mark a sign of unity, as Zelensky's attendance at the summit had been in question. Now, Russia's war in Ukraine tops the agenda items at the agenda list for NATO leaders, along with discussing a future pathway for the war-torn country to join the alliance.
And after over a year of its application, Sweden has finally got the get-go to join NATO military forces. This after Turkey and Hungary gave the green light for it. So we break it down here on what this move means and how it will keep the nation.
All eyes are on the biggest international story at the moment. The US president is going to meet his Ukrainian counterpart, Volodymyr Zelensky, and this is going to happen at the NATO Summit in Lithuania. The war in Ukraine and, of course, the West's military assistance to Ukraine, top of the agenda of that meeting. But, of course, the elephant in the room is the question of Ukraine becoming a member of the North Atlantic Treaty Organization, which we know as NATO. That becomes even more crucial now that Turkey has lifted its objections to the membership of Sweden, which in a way clears the way for the Scandinavian nation to become the 32nd member of NATO. Remember, NATO is a security alliance that was founded back in the year 1949 by the US with 11 other countries. It happened after the end of the Second World War, and its primary aim was to challenge Soviet expansionism in Europe. And while the Cold War ended in 1991, NATO continued to expand. While Sweden and Finland may have become NATO members in record time, Ukraine's membership looks highly uncertain. Just ahead of this summit, US President Biden has gone ahead and reiterated that NATO is yet to arrive at a consensus to bring Ukraine into its fold. President Zelensky, too, knows that it is the question of NATO membership that actually sowed the seeds of Russia's war in Ukraine. What is Zelensky hoping for then? Well, he's hoping to get more from NATO, more in terms of weapons, more in terms of military support, just to keep the Russians at bay. So in a recent interview, Zelensky demanded that Ukraine get clear security guarantees, even if it does not become part of NATO. Now, the big question is, why is Ukraine's NATO membership so very crucial? Well, remember, Russia is strongly opposed to Ukraine joining NATO. It sees NATO membership as a direct threat to the Russian state. After all, it would bring the US-led Western alliance on Russia's doorsteps. and it would strongly diminish what it perceives as its sphere of influence. So all eyes now on the NATO summit in Lithuania and what comes out of it. Even a subtle hint, the smallest of hints, at accepting Ukraine into NATO's fold could have far-reaching implications in global geopolitics.
All right, with that, let's quickly slip into a very short break, but don't go anywhere. More news and more updates on the Asian markets on the other side as we come back.
Welcome back. You're watching Market Cafe with me, Ankita Saxena, and with me is my co-anchor Snehi Shah. And it is that time of the show where we go domestic. The big news coming in on the domestic front is the GST Council has finally concluded its 50th meeting with the goods and services tax rate trimmed to 5% in 4 items. The Council also exempted GST on several imported pharma products. However, one of the biggest highlights was the 28% tax rate imposed on the full value of online gaming, which is likely a setback for Indian players. My colleague Prakash joins in with the key takeaways. Over to you, Prakash.
The GST Council meeting has been concluded and some important decision has been taken by the Council, and the first one is with regard to GST rates on online gaming, casino and horse racing. Council has decided to levy 28% uniform GST on online gaming, casino and horse racing, and that will be charged on face value. And there will be no differentiation between a game of chance and game of skill. There will be uniform GST irrespective of its degree, and that will be 28%. Apart from that, GST Council has also decided to come out with a comprehensive definition to charge 22% cess up and above 28% GST when it comes to sports utility vehicle or multi-utility vehicle. 3 categories have been decided by the GST Council. Based on that, 22% cess will be levied on this category of sports utility vehicle or multi-utility vehicle. Apart from that, Council has also decided to provide exemption, 12% exemption in IGST when it comes to some certain category of cancer drug. Apart from that, the Council has also decided to come with a clarification when it comes to GST rates on food and beverages being sold in cinema halls. Council has decided to charge only 5% GST on food and beverages that is being sold in cinema halls rather than 18%.
मन में गर्व महसूस कर रही हूं कि काउंसिल में आज बहुत ही इमोशनल तरीके से इसको कितनी दूर तक हम लेके जाना और कितनी दूर तक हम इसको समझना, इसके ऊपर हर स्टेट का भागीदारी रही और जो 2-3 साल से पेंडिंग है निर्णय, आज वो निर्णय हम ले पाए, इसीलिए कि हर स्टेट उसके ऊपर उनके अपने भागीदारी स्पष्ट रखे. There will be some amendment to the GST law to include online gaming also in it. Online gaming, horse racing and casinos will be taxed. They will be taxed at 28% each one, and they will be taxed on full face value.
This is a $2.5 billion industry that is expected to estimated to double by 2025, and there is this entire ecosystem of game developers at the back end, and the entire economics. Apart from the economics, also the human capital element of the jobs that have been created over the last 12 years, and all of that would be put into jeopardy. I believe if this is implemented, because it is just not sustainable. You look at the entire ecosystem is going to get, is going to be upheaval, because you look at, these bright young minds, engineers, and innovators who are innovating in gaming formats as we speak, and that is why there is this large number of gaming companies that exist here. 950. These are Indian-bred, companies with a major proportion being attributed to startup and MSMEs, and then all of these are also funded by investor groups. So that also would be and when the business model itself which is the revenue attributed to the platform for facilitating the service, is going to come under threat, then this entire ecosystem would get imbalanced.
All right, so that's a flat 28% GST coming in on gaming. No difference between game of chance as well as game of skill. But the council also clarified that all multi-utility vehicles, including sports utility vehicles and crossovers, will have to pay a tax of 22% compensation cess over and above the 28% GST rate. Listen in to the Revenue Secretary on this clarification.
SUVs previously or till now, for a vehicle to be categorized as SUV to attract your compensation cess, higher compensation cess, 4 conditions were needed. One is that it should be popularly known as SUV. It should have a length more than 4 meters. Then it should have an engine capacity exceeding 1500 cc and ground clearance of 170 millimeters or above. So now the council has decided that only last three conditions, which is the ground clearance, the length and the engine, but not popularly known as SUV, shall be deleted. Only these 3 conditions shall be necessary. The other thing the council has also clarified is that when we mention 170 mm of ground clearance, then it is without lading, without any weight. So it is unladen vehicle, weight unladen. In unladen condition, the ground clearance shall be seen.
And moving on, Tata Group has signed an agreement to acquire Apple supplier Wistron's factory. Now, this would make the conglomerate the first local company to move into the assembly of iPhones. Reports suggest that the deal could be sealed as early as next month. Wistron is known for the production of the iPhone 14 model. Foxconn, after pulling out of the Vedanta chip deal, has reiterated its commitment to India and furthering the Make in India push.
We have delivered $100 billion electronic manufacturing last year, which is a quantum jump from where we started on this journey. And in addition, you have already seen that we've grown about 1,800% in mobile phone manufacturing in the last 6-7 years. So India has delivered, and India cannot be taken lightly. This is a very positive development, and I think both the groups will continue to remain committed, because the market here, electronic manufacturing, is growing rapidly. We have a very strong government which is prepared to listen to everything.
All right, before we move on with the show, let me take you through all the lineup that we have set for you on the market today at 9:20 a.m. We have Pankaj Tibrewal of Kotak Mutual Fund. He's going to be giving his views on where he sees Dalal Street headed, what market trends he's spotting out and where he's seeing value. Followed by that at 9:35, you have Atul Chaturvedi of Sri Renuka Sugars, and he's going to be talking about the pricing trends in the sugar industry and if he sees these prices going up anytime soon. Followed by that at 10 a.m. you've got to keep your eye on IT earnings, as we have Rudra of JP Morgan as well as Omkar Tangsale of Axis Securities, and they will be talking about where they expect the IT numbers to be headed for this quarter. Remember, today HCL Tech as well as TCS are reporting their quarter numbers today. At 10:20 you also have Devina Mehra of First Global. At 10:30 you have Chandan Taparia of Motilal Oswal as well as Gurmeet Chadha of Complete Circle Consultants, and they will be sharing their take on the HDFC as well as the HDFC merger and if this is going to be a birth of a behemoth on the Indian markets. With that, let's quickly slip into a short break. Don't go anywhere. We'll be right back with more stock-specific action on the other side.
Welcome back. You're watching Market Cafe, and TCS will kickstart its first earnings season this week. We are reporting their numbers as of today. What is the street penciling in? My colleague Anisha is joining in with all the numbers. Over to you, Anisha.
Oh, well, yes, it's going to be a fairly busy day. TCS and HCL Tech will both report earnings post-market hours between 5 to 7 p.m. But to begin with, the expectations are a bit muted. For TCS, yes, the range is very wide because part of the street is expecting a 1.5% decline in constant currency to a part of the street which is expecting a 1% growth. But nonetheless, the consensus seems to be stemming towards that 0.2 to 0.4% growth coming in for TCS on a sequential basis. The dollar revenue as well as rupee revenue is expected to jump up by 0.5%. The profitability is seen around 10,900 crore rupees. Margins on a sequential basis are expected to decline anywhere between 100 to 120 basis point. But that's pretty much expected because Q1 is usually the quarter wherein TCS's impact of wage hikes comes through. So that's the reason we are expecting a bit of a decline. The most important thing this time around will be the commentary, what's happening with respect to demand outlook, what has been the key change from Q4 to Q1, and overall how's the pipeline looking like would be important. Of course, this is the first time that Kriti will speak as the CEO of the company, so his comments will also be very, very closely watched out for. Plus the overall outlook and the headcounts and momentum on the ground is fairly important. There was a part of the street which is expecting buyback. Now the expectations are a bit muted. But let's see what the company delivers, because apart from that, deal wins have been fairly solid for TCS this time around. We're expecting a number of anywhere between 10 to 11 billion dollars on account of that BSNL and NEST deal. So this quarter will be fine, but going forward is something that we need to watch out for.
All right, Anisha, thanks for those details. But stay on with us then and tell us about the other IT major that is going to declare its earnings today, which is HCL Tech. So what's expected in terms of their results and what are they guiding?
Well, yes, for HCL Tech, it might be a bit better than TCS. At least that's what the street is expecting, because on a constant currency basis, we're expecting a growth of 0.6%. That would be largely led by the IT services. P&P is also expected to be modest, but it will be ER&D segment which continues to be sluggish. In fact, there could be a sequential decline when it comes to the ER&D segment. Margins are expected to remain capped around that 18% mark, and the profitability too is seen around 3,800 crore rupees. This time around, the deals are expected to remain flattish. They had announced a couple of deals, so this quarter will be fine, but the commentary going forward will be fairly crucial to watch out for. The big thing, of course, is whether they maintain the FY24 guidance or not. They had talked about a 6 to 8% growth on the top line in FY24 with a margin of around 18 to 19%. Do they stick to that guidance or not will be very, very crucial. Any disappointment there might result in a negative reaction on the stock prices as well. Plus the management commentary on the deal pipeline, headcount trends, and how the ER&D and product business is shaping up will be important. So eyes on TCS as well as HCL Tech.
All right, we will be closing those numbers very closely today. But moving on then, let's take you through all the stocks that you need to keep on your radar for today's trading session, besides, of course, HCL Tech and TCS. And for that, I have my colleague Ashesha joining us for more.
Well, yes, first up, let's talk about Happiest Minds, and this one is in focus on the back of their fundraising plans, where the board of directors have approved fundraising to the tune of 500 crores. QIP has already opened. It is at the price of 972 rupees per share, indicating a discount of about 2.2% to yesterday's closing price. On account of these fundraising plans that have come through, Happiest Minds will be in focus today. Moving on to Prestige Estates then, they have acquired DB Realty South Mumbai land parcel for about 704 crores. So on account of this transaction that has taken place, both of these counters, GB Realty and Prestige Estates, will be in focus today. Moving on to SpiceJet then, over here reports suggest that DGCA has put SpiceJet under enhanced surveillance. The airline, of course, has denied these allegations. Apart from this, the company will also be in focus because board of directors are scheduled to meet today to consider fundraising plans. So on both of these news pieces, SpiceJet will be in focus today. Moving on to Zen Technologies, this counter is in focus on the back of an order win, where the company informed the exchanges that they've won orders worth about 160 crore rupees. This order is for supply of anti-drone system by the Ministry of Defence. So order win is why this counter will also be in focus today. Also keep an eye out on Lupin and some action over here with respect to approvals, where the company said that they've got Health Canada approval for an inhaler drug. So this approval, an important approval that has come in, so Lupin will also be in focus. Lastly, let's talk about M&M. Operational updates for the month of June have started coming in, where sales have come in at 59,924 units for the month of June, which is an uptick of 17% on a year-on-year basis. Exports, meanwhile, has seen a marginal decline. It came in at 2,000. units for the month of June versus 2,700 units that the company had reported same time last year. Marginal decline on the exports front, but total volumes have seen an uptick of about 17% on a YOY basis. And on account of operational updates, keep an eye out on M&M as well.
Alright, thanks Shesha for that complete list of all the stocks that you should be keeping on your radar this morning. But Power Finance Corp or PFC is a stock in focus as it remains perched near record high levels. What's driving this rally, and could this rally be hampered by a delayed resolution in stressed assets? Could that spoil the party? My colleague Vamakshi is joining to tell us all of that.
Well, yes, Snehi, when we look at the company, it has definitely been in the limelight of late. In fact, when you look at it on a year-to-date basis, the stock has almost gained more than 61%. And in fact, over the last 1 year, the stock has managed to almost more than double. Now, what's driving the rally in the stock? Let's look at all those factors. Macro stability, Government of India's thrust, strengthening balance sheet of power value chain participants are presenting a very robust lending story. In fact, analysts at Elara are expecting plant power sector capex to create a financing opportunity of almost 98,000 crores by FY30. Loan book, in their opinion, has finally picked up pace with 133% year on year and 54% on quarter rise as far as disbursements are concerned. Not just that, their loan mix is also evolving. They have a changing loan mix with a thrust on renewable energy as well as distribution. Not just that, when we look at the asset quality, that has improved quite significantly for this counter. GNPA stands at nearly 3.9% for the year FY23, and this in fact is the 6-year low with along with and this has come in on the back of resolution of nearly 17,100 crores from FY20 to FY23. Rapid asset quality improvement is definitely a re-rating trigger for this counter, and in fact the dividend payout is also quite healthy. Nearly 30% is what the dividend payout was in FY23. So those were the factors that actually aided the stocks. But what about the stock ahead? What are some of the triggers? Well, resolution of a few projects are expected to come in FY24 as well, and nearly 85% of their total stressed assets are being resolved currently under the NCLT. Yield is also expected to expand, and that is mainly on account of the upward revisions in prices that the company had undertaken in December 2022 as well as in March 2023. Valuations, most of the analysts believe, do not factor in strong growth as well as sustainable, healthy asset quality prospects. So those were all the positive factors for Power Finance Corp, but it is also mindful to be aware of the risk that could be involved. Now, if there is a higher haircut with delayed resolution, that could be a potential risk for this counter. Other than that, slower than anticipated demand pickup in project financing as well as liquidity schemes could also result in slow loan growth. So largely, those were all the positives as well as the risks that you need to be aware of as far as Power Finance Corp is focused and is concerned rather, and that is the reason why the stock is perched at an all-time high today.
All right. Thank you so much for those details, but please hang in there because you have all the brokerage notes that came in this morning, especially from Nomura and Morgan Stanley. So what are these notes really saying?
Well, we have a couple of notes that came in on the cement counter. Let's first look at the note that came in from Nomura. Now, they have highlighted that there are some very strong near-term drivers which outweigh the structural challenges. The industry exhibits limited ROCE expansion potential, but they do believe that cost moderation could provide impetus to margin amid lackluster prices. So, on the back of that, they maintain a neutral rating on Ambuja, but for Ultratech, ACC as well as Shree Cement, they've downgraded their rating. As far as Dalmia Bharat and Nuvoco Vistas is concerned, they've initiated coverage with a buy rating, and Ramco Cement, they've initiated coverage with a reduced rating. Other than that, we also have a note coming in from UBS on the cement pack, and they have a rather contrarian view. They have highlighted that they have a contrarian view on rising competition as well as expensive valuations. They do believe that there is a margin tailwind for now, but pricing is and may worsen on overcapacity. Companies are resorting to organic expansion while inorganic deals are drying up. So overall, from the entire cement pack, they do prefer ACC as well as Ultratech, but they have an anti-consensus sell on Dalmia Bharat. So for ACC, they've actually maintained a buy. For Ambuja, they've downgraded. Ultratech, they've downgraded their rating, as well as for Dalmia Bharat, they've downgraded their rating from buy to sell. But nevertheless, for Dalmia Bharat, they've hiked the target price from 2,103 to 2,380 per share. Other than that, keep an eye out on Zomato. The stock is in focus after a brokerage note that has come in from Morgan Stanley. And as far as the first quarter is concerned, they do expect a good quarter for Zomato. Strong gross order value growth is expected to drive operating leverage as well as better profitability in the core business. quick commerce losses are also expected to continue to decline on a quarter-on-quarter basis, and in fact they're expecting stable take rates as well as contribution margins. So all in all, a good quarter is expected to come in from Zomato first quarter. And lastly, keep an eye out on delivery, another preview coming for this counter from Morgan Stanley, and they have highlighted that they're expecting express parcel volumes to decline nearly 5% sequentially, but nevertheless they're expecting consistent recovery in the PTL volumes. They're also expecting slight increase in the gross profits, but that actually should go and offset the increase in the other overhead costs. They also see adjusted EBITDA break-even close in Q1. So largely those are all the brokerages that you should keep on your radar for the trading session today.
All right, thanks Somakshi for that quick roundup. But let's shift focus then, and all eyes continue to be on the mega bank merger. HDFC Bank is all set to dethrone Reliance as the new Nifty heavyweight. What does this mean for the company's financials going forward? My colleague Harsh joins in with some interesting data on this. Harsh?
Right, so the record date for HDFC Bank shareholders, or rather HDFC Limited shareholders, to receive shares in HDFC Bank is the 13th of July. So the last date for purchase of HDFC Limited shares, if you wish to therefore receive HDFC Bank shares post the merger, is tomorrow, which is the 12th of July. Of course, based on the merger ratio, around a 0.5% gain if you are buying HDFC Limited versus HDFC Bank as of today, as of current market prices. Let's talk about the merger ratio itself. If you hold 25 shares in HDFC Limited, you get 42 shares in HDFC Bank. So 1:1.68 is the merger ratio. Let's quickly move on. It will, once the combined bank goes through, it will be the 4th largest bank in the world, behind the likes of JP Morgan, the Industrial and Commercial Bank of China, and behind Bank of America as well. So the top three, those three in terms of market cap, this will be the 4th largest bank in terms of market cap, roughly 15 lakh crore. Or you're also looking at a book which is more than twice the size of an ICICI Bank, which is the next largest bank after SBI and HDFC Bank domestically in terms of loan book size. 22.5 lakh crore is the loan book size of HDFC Bank, more than 8,000 branches and more than 10 crore customers, which the bank on a combined entity level, including all the subsidiaries, will have. So 10,000 plus customers. You're also looking at what will happen in the F&O space. 12th of July will be the last date with regard to contract expiry on HDFC Limited. All the F&O contracts will expire on that date. Also, in terms of what's happening with regard to sectoral indices, HDFC Bank will have a weightage of 14.4% on the Nifty, around 29% on the Bank Nifty, and LTIMindtree will replace HDFC Limited. Around 0.5% is the weightage given to LTIMindtree on the Nifty. Where the Sensex is concerned as well, JSW Steel will replace HDFC Limited on the Sensex index, and 0.9% is the weightage ascribed to JSW Steel on that substitution happening. Broadly, HDFC Bank in focus. If you want to buy HDFC Limited shares, tomorrow is going to be the last day.
Absolutely, Harsh. Thank you so much for all those details. Do watch out for HDFC Bank stock in today's trading session. Moving on then, markets hit an all-time high in June and mutual funds churned their portfolios. Now, what did they buy and what did they sell? My colleague Sharad is joining us for more details on this. Over to you, Sharad.
Well, yes, for the month of June itself, we see more than 8,000 crore has been flushed in by the mutual funds for the secondary markets. And do remember, there are certain segments where there has been a strong addition, which is the healthcare, auto ancillary, as well as the metal segment. Now, the reduction in exposure coming in for the IT, financials and the staples pack. And the cash levels, that has also come down on a month-on-month basis to almost 4.8%. Now let's look at what the action is coming in the large caps. We can see buys coming in for Coal India, ONGC, HDFC, while sell is being reported in the banking names such as HDFC Bank as well as Axis Bank. Of course, we also have PNB and Tata Motors also coming to this list, while the newest tech stock, we have Zomato as well. Amongst the mid-cap, we see over here, we have NMDC, Indus Stars and Nykaa being strong buys coming in, while the sells coming in for the Indian Hotels and Federal Bank. Apart from this, also we have Bank of Maharashtra and NHBC coming into the list for the mid-caps. So we did speak about the large caps and the mid-caps, but the action is also there in the small cap space. as a lot of inflows, there are record inflows coming in the small cap funds, and you can see stocks, especially in the power segment, infra segment, Suzlon, TD Powers, and even Kalyan Jewellers saw very strong buying coming in the small cap, while IEX, HCC saw cuts across the board. Apart from this, even Manappuram Finance saw strong buying happening, while for sell, there was Rain Industry. From the banking space, RBL Bank.
All right, thanks Sharad for all those details. Let's move on then, and time for some important market opinion then. We caught up with a whole host of market experts, but first let's listen in to Vetri Subramaniam of UTI AMC to understand what he makes of the current market moves and the sectors and themes that he's liking. Listen in.
In terms of the sectors where, I think you have valuations which are still mid-cycle, so they're not sort of blinking red as yet at this point of time. Financials would certainly count as one. The earnings over there are still coming in quite strongly, and I mean core lending businesses when I talk about financials. So that would be an area where we would remain positive. The same I would say for automobiles, where I think the whole recovery of volumes in automobiles to the levels that we had seen in 2019 prior to a very significant downturn are yet to be achieved in categories. So I think autos still have the benefit of an earnings cycle which looks powerful. So I would tend to believe that IT is an area to look at incrementally positively. Maybe the window is slightly wide, it's broad, so take your time over the next 3-6 months to sort of increase allocations. But let's not forget one thing. This is the one sector which has created the most globally competitive companies out of India. This is a sector which has learned how to ride every wave of IT change and transition, and I do think I would tend to bet that they can do it again. But yes, you could use some adverse news flow over the next 6 months to increase positions, but incrementally I am more constructive into bad news as opposed to being negative. So that's an interesting question. And, I think one of the things even I should caveat here is when we look at domestic pharma and healthcare, it's a very, very disparate sector. And you've had some parts like hospitals do amazingly well over the last 18 months, but sort of core pharmaceutical, whether it's domestic, export oriented, they've underperformed, diagnostics have underperformed. But I think what we are seeing over there is more bottom up, which is to say I'm seeing companies now focus on brass tacks, getting the cash flow in place, making the right capital allocation decisions and looking to improve ROC. And that's kind of the environment historically I've associated with very positive outcomes over the near to medium term. So, I would tend to be positive on stuff which is more domestically oriented, be it domestic pharma, formulations or diagnostics. But equally, I would say even the export area to me is now looking more interesting. I'm talking about generics to developed markets, because we are clearly seeing that in those markets, now many companies have started to vacate space, and therefore there's a lot more sensible stuff happening as far as generic pricing is concerned. So again, for all these reasons, I think this is an area which is worthy of attention on a contrarian basis.
All right, then those are the bets coming in from the market veterans. Thank you so much for tuning in. We are completely out of time of this edition for Market Cafe. Snehi and I will take your leave. Do stay tuned for the market.